So does whole life insurance actually work? If you heard something was bad, what would change your mind? Would hearing from someone else that, hey, this is really good, would that make you all of a sudden think that that thing is now good? Probably not. What if you saw some proof? Would that change your mind? Yes, that would change my mind. So today, we're going to look at whole life insurance, and we're going to look at some proof of actual performance, showing that it actually works when it's set up correctly. So what we've got is a policy for a doctor who started when he was 45 years old. He started his policy in January of 2020, and his original plan was to fund $200,000 per year for 5 consecutive years, which gets a total of $1 million into the policy. The company he selected was one of the major mutual companies, being Mass Mutual. And one of the things that we're going to look at here, we hear this from a lot of people, is if this policy performs like what the illustration shows, I'll keep adding money. However, I'd like to see proof, meaning I'm going to look at what this illustration shows and then what actually happens every year to see if this actually works or if all of the naysayers are correct. So the original illustration, when he started his policy back in 2020, that illustration was based on the dividend interest rate in 2020, which was 6.20%. So whenever we look at an illustration, that illustration is going to show values, specifically the cash value growth, that is based on the assumption that the dividend rate will never change. Here's the thing, it probably will change. So let's start with the original illustration. This is what we looked at when we first connected. So it's with Mass Mutual. Here we go, Mass Mutual up top. When we look at the policy, here's his out-of-pocket, I should say the original illustration, $200,000 per year for 5 years. Now this policy is designed for maximum cash value. He was putting money into this policy for the cash value benefit. That's what he was interested in. So how you can tell that the policy is set up for maximum cash value is by looking at where the money is going, which we can see up here. So his premium was $20,000, which is 10% of his total out-of-pocket, and we dumped the rest of the funds into different riders that maximize the cash value. It's mostly refers to your paid-up additions or PUA rider with most life insurance companies. But the purpose of mentioning that is just to state that this policy was set up for maximum cash value from start to finish. When we look at the cash value over here, first year, paid in 100, he had 175 and change. By the 5th year, he has now paid in a total of $1 million, and he has just over $1 million. So again, this was the original illustration. If we scroll down here, we can see the date on the illustration, that it was prepared August 12th of 2020. Now his policy date is January 2020. The reason why is because we did what is called policy backdating. So we locked in a start date of January 2020. So that's a start date, January 2020, and if we look at the next page, it assumes no payments, but his cash value just keeps growing over time. So what we want to look at here is the actual performance. Compared to the original illustration, how has the policy performed? Well, when we look at the actual results, the dividend rate has changed. So when he started his policy in 2020, the dividend interest rate was 6.20%. What happened the next 3 years? The dividend rate came down to 6% and stayed there. Then in 2024, came up a little bit to 6.10%, and now in 2025, 6.4%, so it's come up a bit. So the actual results are going to be based on that dividend rate. So as the dividend has changed, that means his actual values are going to be different than what the original illustration showed. But the performance should be similar because that original dividend was 6.2%. Granted, it's changed a little bit. It's very similar to where the dividend was when he first started. We shouldn't see that much of a difference in performance by year 5. So here's what we want to look at to track the performance. First, we want to look at the annual statements. This is what you will receive every year from a life insurance company that you have a whole life insurance policy with. It's an annual statement that shows you your cash value, death benefit, information on loans, if you have a loan outstanding, a bunch of information, but what's most valuable when we're tracking the performance is that end of year cash value. Then we'll look at what is called an in-force illustration, which is similar to what we just looked at, but it shows a future projection. This is not the best thing to look at for actual results. However, we can see what things will likely look like as time passes. So let's take a look at the annual statements, and then we'll look at a side-by-side comparison. So let's start with this original illustration. The illustrated cash value was $175,585. When we look at the first annual statement, here we go. So he paid his $200,000. There's the payment. And there's the end of year cash value, $175 and change. A little bit less than what was originally illustrated. Usually the actual performance is spot on with what's illustrated. Why his was a little bit less had to do with that backdating we mentioned earlier. When you backdate a policy, the PUA deposits you make are applied based on the month that you make the deposit. So his policy date is January, so January 22nd to be precise. He made his first payment in August. So because that first payment was several months after starting the policy, that resulted in a little bit less in the first year, but not really material when we look at it. But we see what his actual cash value was at the end of the first year, end of the second year. What do we see? What's nice about Mass Mutual's annual statements is we see the prior year, there's that 175 and change, and then the end of the current year that we're in, 358 and change. Okay. We're going to compare this with the original in a moment, but then we've got 2023. There it is at 562 and change, and then 2024 at 781 and change, and we've got 2025's cash value on the workbook we're about to look at. So let's take a look here. What we want to look at first is, again, the original illustration. We're going to use this as the reference to see how the policy has actually performed over the years. So the first attachment we looked at is what we've got up here. This is the original illustration. There's that year 5 cash value of $1,012,000 and change. So let's compare that with what actually happened. So what we've got here is another illustration we're going to build out, but there's one more column on the far right. Cash value difference. This is going to show how much more or less he had in actual cash value compared to what was originally illustrated. This is what he was interested in. So let's look at year 1. What do we see here? He paid $200,000. His cash value was $175 and change. His illustrated cash value was $175 and change. The illustration had $464 more in cash value than what actually happened. And that is, again, because of the backdating. But there's the difference. He had $464 less than what was originally projected in the first illustration, in the original illustration he looked at. How about the second year? What do we see here? Well, look at this. He paid exactly the same. His cash value, though, $358 compared to the original at $359. $1,400 less. Why so much less? Backdating is not going to do that. Dividend rate came down 20 basis points. We're at 6% flat instead of 6.2%. And remember, it stayed at 6% flat for 3 consecutive years. So when we look at the next 3 years, what happens? He's close At 2023, in 2023, he's at 780, 795, whereas the original displayed 783, 276. So he's close, but his difference is about $2,500. His actual results are $2,500 less than what was originally illustrated at the end of policy year 4. All right, the dividend rate started to come back up. Now we're at 6.10% with MassMutual. And look at this. So they bumped their dividend rate. What's nice about this, their expenses came down a little bit too. There's more to a dividend rate than just the interest rate component. You've got insurance expenses, mortality charges. My point is, that slight bump there was actually more than the 10 basis points. And when we look at it, at the end of policy year 5, pulled this from the in-force illustration, $1,013,000 in change compared to $1,012,000 in change. So we got a nice little bump in performance, which puts him at $879 and change. So at the end of this policy year, he's almost spot on with what was originally illustrated. The little bump in the dividend interest rate helped quite a bit, which is nice. So as we look at things moving forward, before we do that actually, what did we originally say about folks that get these policies and want to make sure they work? If it works, then I'll add more to it. The original plan was to add at least $1 million. Just spoke with him, and he's looking to add more money. So here's what it looks like if he pays just the minimum, $20,000 per year. We originally set it up to fund $200K per year for 5 years. If he keeps on paying the minimum, we'll see that it will continue to grow the cash value year over year. Everything we see below that red box is from the in-force illustration. So we've got to look at the annual statements each year to match up the actual performance, but this is from the projection, just like the original projection. The difference is this projection is based on a 6.40% dividend rate. Remember that the dividend rate is gross, not net. That's why we've got the annual rate of return. That's his net annual yield when we look at that column. Peaks out at almost 5.4% when we look at that. But the cash value difference based on the dividend rate as of 2025 really helps as we see that cash value just pull ahead. Now, also keep in mind, he's pumping in another $20K per year. So if we wanted to see the true cash value difference, we would want to back out those $20,000 per year payments. But my point is, when we look at the annual yield and compare it with the original, it did what it was supposed to. The first 5 years was a little bit lower initially, which is expected as a result of the dividend coming down. But then when we keep on tracking it each year, especially in recent years, as we've seen the dividend come back up, and his payments have been spot on with the original plan, we see, okay, it's performing. I don't have to try to dig into it to explain the unexplained as far as the product not delivering because of some games the company played with the dividend or something like that. Let's look at one more in-force illustration, and this is what he will likely do. He said that he'll probably keep on adding $200K per year because he likes the way that it's performing. He's used this policy over the years. He invests heavily in real estate, so he's leveraged it via policy loans. MassMutual's a non-direct recognition company, so he's continued to receive the same dividend on his entire cash value the whole time. But as we look at this, this is what he'll likely do, is keep on feeding the policy to the 10th year, where the original plan was to get $1 million in. Now he'll get a total of $2 million in, and this is based on the current dividend rate, but now he's got a ton of cash value. That's just steaming for him as the years pass. So, does whole life insurance actually work? Yes, it does. Here's the big thing though, because while this is a showcase to show some proof of a recently issued policy, it's only 5 years old, that it works, I can also find policies that have not worked. Here's what I would always do to make sure that you get a whole life insurance policy that actually works and you don't have to worry about an overpromise and underdeliver game. Two things. First, company selection. We've seen policies with the 4 major mutual companies always deliver, which are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. Select one of the 4 major mutual companies. That's what I would recommend, simply because we've seen that proof of performance. It's been consistent. I feel comfortable putting my money there. When we look at banks and corporations we work with, they're going with those 4 major mutuals. The second thing, policy design. Make sure that the policy is set up with an absolute minimum premium, as low as the insurance company will allow you to set it or will allow the agent to set it. That will result in the strongest guaranteed cash values when you look at the illustration, and it will also result in the lowest agent compensation. Not to say agents should not get paid, but when we look at those designs where compensation is minimized, what we've always seen is that it maximizes the cash value for the policyholder. So, company selection and policy design. Those are the 2 steps I would follow to get a policy set up for maximum cash value, so you can say with your whole life insurance policy, I have proof that it performed. Hope this helps.